Hello everyone. Today we are going to talk to you about intangible assets. Intangible asset is also a form of asset which is required to be recognized in the financial statements. So it's a very important concept for you to understand. So in the previous module, which was India 16, we talked about fixed assets, which are tangible assets, right? Now, Ind AS 38 is what talks about intangible assets. So what are intangible assets, right? When you look around, right, what are intangible assets? So when you look around, intangible assets are nothing but say goodwill, right? Goodwill is a form of intangible asset. Then you look around to say, okay, I have patents. Patent is nothing but an intangible asset. Copyright, right? Trademarks, right? You may have IPR&D, which is intellectual property rights, and in a way where you do some research work, right? And then you create certain processes, right? They're also a form of intangible asset. Then we have motion pictures, right? Television rights, right? You have distribution rights. So things which do not have a physical presence. That's what we need to understand. Assets which do not have a tangible presence, which you cannot in a way feel, right? So now because of the pandemic, right, as we know that many of the things have moved virtual, right, and hence the importance of the virtual assets, which are nothing but intangible assets, has also increased many-fold. Now, lots of companies are investing time, resources, energy in terms of coming out with solution for the COVID-19 drug, right? Now, the whole drug discovery process is also, in a way, you're trying to create an intangible asset, right? Which is in process research and development. Now, the question is that whether that expenditure, again, what you have incurred here, whether that is eligible for capitalization. Is that a capital expenditure or is that a revenue expenditure? So what are the rules around the same? What is it accounting standard is saying around the same? So our objective will be here as part of this accounting standard is to understand what is the meaning of an intangible asset, what are different types of intangible asset in a way which is out there, and then how do you look at the whole capitalization process? How do you measure intangible assets at initial recognition? How do you do subsequent measurement, like on fixed asset we talked about, right? The similar type of stuff is what we need to understand now, and not for the fixed asset but now for the intangible assets, right? So what is it an intangible asset all about? What are the criteria for recognition of an intangible asset? How do you measure an intangible asset? Now, once you have recorded an intangible asset in your financial statement, now what do you do with that? So which is the amortization. So how do you again determine the estimated useful life, the residual value, the subsequent measurement, which is a historical cost model or a revaluation model, and then eventually once you have disposed it, now how do you in a way deal with that? And there could also be a situation for impairment for intangible asset. Like similarly for fixed asset, you could also have here some impairment triggers, and hence you also need to test it for impairment. And we will try and understand that what are the scenarios in which you need to test it for impairment, when do you need to test it for impairment, and then some related disclosures, right? We also need to understand related disclosures as we in a way deal with that from that perspective. So what are the disclosure elements from that perspective? So all of that in totality is what we will try and understand as we go through this standard. Again, when you think about this standard versus fixed asset standard, right? There are some fundamental differences between the two, and I will try and impress upon it. But Everything else is largely same in terms of concept, right? As to, is it a type of a capital expenditure? Then how do you recognize it? When do you recognize it? How do you measure it? How do you do subsequent measurement? How do you deal with the depreciation, amortization? What are the disclosure requirement? All of that is what we will aim to cover as we progress. Now, let's try and understand the importance of this from the perspective of examination trends, right? And what you see here what you see here is that this standard is relevant, not to that extent as what we had the tangible asset, right? And in last several terms of what we see, only in May of 2019, there has been question being asked on this, and that also for 5 marks, right? So we will cover that. We will cover the question which was asked in the examination of May of 2019. But again, it is important. This is a easy, in a way, standard to deal with. Once your concepts are clear, I'm pretty sure that you will be able to deal with this if there is any question which do come up. So it's important for you to get the concepts right. Important for you to get the concepts right. Important for you to understand when you again look at any accounting standard, what's the scope of the standard, right? What is being kept out of the scope of the standard. Now, once you understood the scope, then how do you got to determine the recognition? When do you recognize this under the standard? And then how do you measure this? And then how do you deal with the subsequent measurement? So when we talk about measurement, there's two things comes in, which is the initial measurement and subsequent measurement. And then how do you deal with the disposal? And then how do you deal with the disclosures, right? So we're going to talk about all of that as we progress here. So from a scope and recognition perspective, now we're going to talk about scope of the standard, right? So as I was saying, that from a scoping perspective, it will talk about all intangible assets. All intangible asset, it covers all types of intangible asset, except certain items, which I'll try and explain. Things like financial assets, right? Financial assets, which are, let's say, your share certificates, right? Now, share certificates are also nothing but a type of intangible asset, right? But they are not governed by the accounting requirement under Ind AS 38, but they are governed by accounting requirement under Ind AS 32. So once you understood what is an intangible asset, we now need to understand what is being covered as part of the requirement of Ind AS 38. So it applies to all intangible assets except financial assets as defined in Ind AS 32, exploration and evaluation asset defined under Ind AS 106, or if they are development and extraction of mineral oil, natural gas, non-regenerative resources, etc. All of them which are kept outside the scope of Ind AS 38. Again, you remember the principle which I have explained to you is that if there is a specific standard which addresses the accounting requirement for that particular type of asset or a transaction, you are supposed to follow that particular standard. If it is not covered, then you follow the broader standard. So intangible asset is a broader standard, but if there's something very specific which are covered in Ind AS 32 on financial asset, then you are outside the scope. You will deal with the financial asset accounting under Ind AS 32. Similarly, for exploration assets, we talked about, which is at Ind AS 106. And again, I'm going to talk about all of these standards in more degree of detail. For each of them, you'll get a good understanding as to how do they operate, what are the nuances, what are the differences. But for everything, you need to keep in mind the broad structure of any accounting standard, right? The broad structure of any accounting standard is that you got to look at the scope, you got to look at the initial recognition, you need to understand the measurement, which is initial measurement, subsequent measurement, and then you need to look at the disposal, and then you need to understand the disclosures, right? All of that is what you will broadly see in every accounting standard, which are part of Ind AS framework. So let's try and understand this a little bit more in terms of the scope. So if another standard prescribes the accounting for a specific type of intangible asset, an entity applies that standard instead of Ind AS 38, which is what I just said, right? So if there is a specific standard, so for example here, employee benefits, right? Assets arising from employee benefits, now they are to be covered under Ind AS 19. And again, they're not tangible asset, right? When you look at currency, right? Currency is not tangible asset, so to say. If I have to pay or receive, that's again a form of intangible asset, or so to say, or actually a monetary asset, from that perspective. So an asset arising from employee benefit for which Ind AS 19, you don't need to account for that under Ind AS 38. Similarly, intangible assets which are held by an entity for sale in the ordinary course of business, to which the Ind AS 2 inventory apply, right? Now, a simple example could be, let's say, an entity which is engaged in the business of selling softwares. Now, if you are selling softwares, a software which otherwise is an intangible asset, right? But your business is buying and selling software. Because you're buying and selling software, that becomes an inventory for you. If it becomes an inventory for you, then you need to apply Ind AS 2, and you were not going to apply Ind AS 38 to determine that, when to recognize, how to measure, how to deal with the subsequent accounting. Do I need to amortize? You don't need to amortize if it is for trading purpose, or if you're a reseller, right? Even though you are stocking, let's say, even though you may have purchased such software in advance, and then you are a reseller of such softwares, right? So depending upon the purpose for which you are owning a particular asset, you're going to account for that in that particular accounting standard. So again, Ind AS 38 looks at intangible assets, which are held for the purpose of production, or for supply, or again, for rendering of services, or for rentals, or for administrative purposes. So all of that is what you need to understand and keep in mind. So if it is employee benefit, outside the scope. If it is inventory, it is outside the scope. Or it could be something which has been classified as an asset group, which are included in a disposal, right? If it is part of the disposal group, remember what I said last time, that you're going to then account for it under Ind AS 105, right? Then you will not account for it under, again, Ind AS 38. If it is asset group which are held for disposal, then you need to account for it under Ind AS 105. You don't need to account for it under Ind AS 38. So fundamentally, you need to be clear that intangible asset, Ind AS 38 is applicable to all types of intangible assets, unless you are scoped out, right? Unless there is a very specific guidance for that particular type of asset which is covered in another accounting standard, then you will go to that accounting standard to deal with that. Otherwise, Ind AS 38 in a way provides you an accounting framework for all types of intangible assets. Now, let's look at a scenario where intangible assets are contained in or on a physical substance. Now, this is a common issue which we deal with in a way. Let's say a very simple example is computers, right? Or laptops, for example, right? Now, a laptop is a beautiful machine, right? Which has tons of hardware, which is in a way all coming together, and then they form a machine to operate and give you a desired outcome. But for that hardware to operate, you actually need a software, right? For the hardware to operate, you need a software. Now the question is that, do I need to capitalize the software separately, or do I need to capitalize the hardware separately? And that is where an element of judgment do come in, that what is the most significant portion of the cost of that particular asset class. So now in a way, the computer software for a computer control machine that cannot operate without that specific software is an integral part of the related hardware and is treated as property, plant and equipment. And this also applies to the operating system of a computer. So important thing for us to understand is that all of this is, again, there are areas of judgment here, but more often than not, if it is an integral part, you can't operate the hardware without the software, then it is capitalized as part of the property, plant and equipment. But we also see that let's say nowadays softwares are available as an enterprise license, for example, right? Let me just kind of extend this whole example of Microsoft, right? Now MS Windows may is an integral part of the hardware or a computer laptop for a laptop to operate, but MS Office is not necessary for that laptop to operate. So if you purchase MS Office, that is an independent software or an intangible asset which is required to be accounted for under Ind AS 38. But if you're paying a license fee to have MS Windows, which is integral part of the computer system itself or for the computer to operate, then the license cost for MS Windows is actually going to capitalize as part of property, plant and equipment and accounted for under the Ind AS 16 framework, whereas the license cost for MS Office is actually a software cost which is going to be accounted for under Ind AS 38 framework. So it is important for you to understand that if there is a software which is embedded or an intangible asset, which is, let's say, common example which we also deal with, let's say a book, right? So if you purchased a book, whether that is an intangible asset or a tangible asset, so the value which is being derived on a let's say work of a copyright, for example, the value is actually the intangible right, which is associated with that work of the storytelling, or whether it is a fiction or a non-fiction or whatever it is, for example, right? The value is not that paper, right? A paper is what deriving its value. The value is that the knowledge which is or the author views or the author statements is what is driving value in that book, right? Or in a film, right? One can say the film is available in a reel, right? But that reel is not is physically, you can feel it, but that's not the tangible asset. The intangible asset in it is the whole idea as to that you kind of produced a picture, right? A motion picture, and that is an intangible asset. So you got to again look at some of these elements very, very carefully, and you may be required to apply some judgment here. And many situation, it's pretty kind of straightforward as to whether you are dealing with a tangible asset or an intangible asset. So that's what is what we're trying to say here. And when the software is not an integral part of the related hardware, computer software is treated as an intangible asset, right? Now, if it is a important integral part of the hardware, then you need to capitalize it as part of property, plant and equipment. Otherwise, you're going to capitalize this as part of an intangible asset. So broadly speaking, I'm sure you understood that how do you identify the intangible assets, right? And whether they're covered under this standard or whether they are to be dealt in another standard. So now we're going to talk about that how do you identify the intangible asset, right? That whether they meet the requirement for capitalization or not. So there are broadly in a way two requirements, right? These are the two essential requirement. Is one is that it has to be, of course, a non-monetary asset, which is inherent in the definition of an intangible asset. That it has to be a non-monetary asset without any physical substance, and all the examples in a way which we talked about. But the two fundamental thing is what we need for it to qualify as an asset, right? Or to qualify as a recognition criteria is that it has to be controlled by the entity, right? And you go back to the basic definition of an asset itself. For anything to qualify as an asset in your balance sheet, it has to be controlled by the entity, right? It has to be controlled by that business enterprise. Or for you individually, if you believe this is my asset, now if this is your asset, then it has to be in your control, right? You should be able to determine that for what purpose I'm going to use it, or for what purpose I'm not going to use it. So whether you want to use it, whether you don't want to use it, all of that has to be determined and controlled by that enterprise. So it has to be in my control, right? So for an asset to qualify in my balance sheet, or for an intangible asset, it has to be controlled by the entity, and there has to be existence of future economic benefits. For anything, again, to qualify, for anything to qualify as an asset, there has to be a future economic benefit. So if there is no future economic benefit, then essentially it's nothing but a revenue, expenditure, or a period cost. It can only supposed to be capitalized if the benefit from the usage of that asset actually going to extend beyond one accounting period. So if they go beyond one accounting period, then only you are supposed to capitalize, right? Otherwise, you're not supposed to recognize that as an asset, and whatever money you spent on that acquisition or on that particular intangible asset, that nothing but a period cost. So two important criteria is what we need to know. Is it has to be controlled by the entity, right? And there has to be probable future economic benefit that there is an expected. Now, if you look at this criteria are similar to recognition criteria, what we looked at for fixed asset, right? In a way, it has to be controlled, it has to be probable future economic benefit. And then, we're going to look at more to say that the cost has to be reliably measurable, right? You should be able to determine the amount of the cost which you need to capitalize. Here in intangible asset, additional thing is that there should not be any, there is no physical substance. In a way, it has to be a non-monetary asset without a physical substance, and all of that, in a way, put together qualifies as a definition for an intangible asset, to be recognized in the financial statement. So now I'm going to give you more examples, right? I'm going to give you more examples that what are the different types of intangible asset is what we see. What are the different types of intangible asset is what we see. And what you see here, intangible assets could be a contract type, could be marketing related, could be customer related, could be artistic related, could be technology related, right? So there are multiple types of intangible asset is what you can potentially have, which may come from the contractual right, which may come because of your customer relationship, which may come because of marketing related, which may come because of artistic related or technology related. And then there are a number of examples which are out here against each of these categories, right? So if you look at the contract based, right, lease agreement, now right to use is also in a way an intangible asset, right? But remember, right to use is accounted for under Ind AS 116. Right to use is not accounted for under Ind AS 38, right? The franchisee agreement, right? You need to again evaluate whether the franchisee agreement has to be accounted for under Ind AS 38 or has to be accounted separately. So franchisee agreement, you could have employment contract. The employment contract, again, that's a type of an intangible asset, but you may have to account for it under Ind AS 19 and not account for it under Ind AS 38. You could also have operating and broadcasting rights. We talked about this, right? The rights around motion pictures, so cable TV networks and things like that. All kinds of rights, right? Which emanates from contract. They are a form of intangible assets, right? Then it would be marketing related, right? Trademark, internet domain names, or non-compete agreements. So many non-compete is something we see very commonly in business combination arrangements, and we'll talk a lot more about this with some of the examples, and also a lot more when we will try and do Ind AS 103 on business combination. But so you could have a contract related, you could have a marketing related, you could also have customer related intangible. What are the customer related? Which is a contractual customer relationship, could be non-contractual customer relationship, a customer list, internet domain names, etc. So all of them are also a type of intangible asset. There could be artistic related, right? Magazines, musical works, pictures, paintings, right? All these paintings which are very expensive, many times they're also nothing but a work of art, and hence they're also an intangible asset. There could be technology related, right? We talked about some of these softwares and trade secrets and a database. All of them are also a type of intangible asset. So intangible assets are broadly grouped into these 5 categories, right? Which are contract related, which are market related, or customer related, or technology related, or artistic related. So these are 5 different categories of intangible asset, which potentially is out there, which you need to consider as you apply this accounting standard for the purpose of recognition, subsequent measurement, disposal, or derecognition, and related disclosures, from that perspective. Now, we talked about that an intangible asset has to be controlled by an entity, right? And there has to be a probable future economic benefit. And it has to be an asset which is a non-monetary asset without a physical substance, right? So the question here is that how do you identify an intangible asset, right? So how do you figure out, is there an intangible asset which exists or not? So there are 2 criteria in a way which are looked at. Potentially there are 2 ways you can identify that there is an intangible asset which exists here. And one is something which we call as arise from contractual or legal right. Now this is far easier for you to identify, similar to what we talked about contract related, we talked about customer related. Let's say a non-compete. If you've signed a non-compete agreement, it is clearly coming in from your contractual or legal right, and hence it is an intangible asset. So you need to identify an intangible asset. Identifiability can be done from 2 perspectives, right? One is called contractual, right? Contractual. Try and understand this, right? This is very, very important. How do you identify an intangible asset? It can be either a contractual or emanating from other legal rights like copyright, like trademarks, right? Like patents. Now, all of them are actually coming from a legal right because I have now got this thing registered in my name. So I have a legal right over this intangible asset. The other one could be it is separable, right? Capable of being separated or divided from the entity and sold, transferred, licensed, rented, or exchanged, either individually or together with a related contract, identifiable asset or liability, regardless of whether the entity intends to do so or not, right? So it is something, then an asset what you have, and what type of asset it can be. Again, we go back to those 5 criterias, right? And what are those 5 criteria? What are the 5 types of intangible asset you can potentially have? It can be contract related, could be marketing related, could be it could be customer related, it could be artistic related, or it could be technology related, right? So these are the 5 different categories of intangible assets. Now, separable, if I have to give you a very, very simple example, let's say there is a work of art, right? And you've done this, you are MF Hussain, right? And you've done this painting. Now it is clearly separable, right? It is clearly separable, capable of being separated or divided from the entity, and could be sold, transferred, licensed, rented, or exchanged, right? Now that's separable, that's clearly an identifiable intangible asset. Or the example for a contractual or legal right, we have many examples on contractual or legal rights which we've talked about, which is your non-compete agreements, or a trademark, or a copyright, or a patent, or so on and so forth, right? So all of them in a way, so for an intangible asset to be identifiable, it has to meet either of the criteria, whether it has to be identifiable or contractual. So it has to be either identifiable because it is separable, right? Separable from that entity, could be divided, could be taken out, could be sold, could be rented, could be exchanged, etc., right? So you got to meet the requirement for separable, or it has to emanate from contractual or legal right. And we've given the example on separable, a very simple example like a painting, right? It can be separated, or a contractual or legal right. There are a number of examples, which is out there. So we're going to work through the example now, and let's look at this question. So Alpha Limited has been operating a strategic consulting business from a decade, has been operating a strategic consulting business for a decade, right? Through its services, the company has gained customer market share of 40%. Alpha Limited wants to recognize his market share as an intangible asset. All right, awesome. is the action by the company justified? So remember, what is an intangible asset? Something which do not have a physical presence, right? As we've been discussing, and when you record an intangible asset, either it meets the contractual or the contractual legal criteria, or the separability test, right? And ordinarily, the hurdle for an internally generated intangible asset is very high. You are anyway not permitted to record internally generated goodwill, right? But for other intangible also, it is very high, right? So now here the situation is that I've been providing consulting services. Company has gained a customer market share 40%. Can I record this as intangible asset, right? Again, the customers can come, go. There is no contractual legal criteria. There is no separable thing here. So the market share achieved by Alpha Limited will not meet the definition of intangible asset, as the same is neither separable nor have a contractual or legal rights, as the customer can move to another company for obtaining services. There is no control. So I got to demonstrate control over these customers, which I don't have. All right. So that's what is important for us. And then you remember the recognition criteria. Once you identify an intangible asset, when do you recognize that intangible asset? Is when you have control, right? When you have control, and you can derive probable future economic benefits. You got to again meet both the criterias for you to recognize an intangible asset. So once you identify the intangible asset, you will recognize it. Once I have control, and I can generate future economic benefit. Now let's come back and try and understand what is the meaning of a control. So a control is defined as an entity controls an asset, again an asset, if the entity has the power to obtain the future economic benefits flowing from the underlying resource, and to restrict the access of others to those benefits. In a way, what is it trying to say? That it is controlled by you if you can actually derive the benefits and consume those benefits, or restrict others, from getting any benefit from the use of such assets. That means it is in your control. So for example, I have a laptop, right? Now I'm just talking about an example of a tangible asset here. Now a tangible laptop is in my control or not, it means I should be able to operate it, and hence I should be, and once I'm the ability to operate it, I'm deriving the benefit from it. Or even if I don't want to operate it, right, it's just sitting somewhere in my drawer, but I have the ability to restrict others to not to operate it, right? That means nobody else can take it from me and start operating. That is, it is my property, right? Same goes for an intangible asset, that for me to say it is under my control, what does that mean? That I should be able to derive the future economic benefit, or even if I am not benefiting anything, I am going to restrict anybody else to benefit from it, right? So for example, I have a trademark, right? I have a trademark, and I am not using that trademark for any of the ongoing business, but I'm not going to let anybody else also use that trademark for any purpose. And that means that I am in control of that trademark. That means I'm in control of that intangible asset, right? So the understanding of control is important for you to realize that I should be able to derive future economic benefit, or I have the ability to restrict the access of others to those benefits. The capacity of an entity to control the future economic benefit from an intangible asset would normally stem from legal rights, right? Which are either they are contractual or legal rights, or you have ownership rights, right? Owners, like the painting, right? You've got an owner because I'm the one who's done it. That's the original work of art, from that perspective, that are enforceable in a court of law, right? Again, everything goes back to say that, can I enforce the control or the right which I have, and the test of that is it eventually can be enforced in a court of law. So to summarize, it is power to obtain future economic benefit, ability to restrict access to those others to those benefit, and that in a way means that I am in control. So now we're going to look at this example, and let's go through this, which is Popular Limited. Popular Limited has a detailed training policy to train their staff on various operational applicable laws and compliance requirement and self-development. Now, for their staff development, right? Uh, a lot of public speaking, communication courses, and all. Now, Popular wants to know whether cost of such training can be capitalized. If I'm providing training to my staff, can I capitalize that training? Again, I got to look at the control test, and that's the separable or contractual legal criteria. And again, the answer here is no. So recognition, an intangible asset is recognized provided the recognition criteria is met, which is the control and the expected future benefit. And whether the recognition criteria is met, now training provided by Popular Limited, right, does allow them to receive economic benefits in the form of increased and improved performance by the staff. However, since the employees can resign anytime from the company, Popular Limited does not have control over the staff as other companies have access to these staff. Let's look at the some more. We'll try and understand some more nuances around the future economic benefit. Future economic benefit could be flowing from an intangible asset. It may include from sale of product or services, from other benefits resulting from the sale of asset, or it could also be by way of saving of costs. So you make your internal processes, right? You make your internal processes more efficient. If you make your internal processes more efficient, now that is where then also you are generating a future economic benefit. An example, some of the examples which are given here is that intellectual property in a production process may reduce future production cost rather than increase the future revenues, right? So even if it's not going to result into increase in revenues, doesn't matter. If you can still demonstrate that the economic benefit can be generated, and how you going to generate the future economic benefit, either by way of reducing cost or by selling that knowledge, or by renting it out. There could be multiple ways you can generate probable future economic benefit, right? So we need to understand both, right? That I'm in control and I have the ability to generate probable future economic benefit. The answer to that is yes, and it meets the identifiable test. Now, when it's going to meet the identifiable test, when it is separable or it is emanating from a contractual or legal right. If it is emanating from a contractual or legal right, then it meets the definition as an identifiable intangible asset. Now, once it meets the definition as an identifiable intangible asset, then I need to see, should I need to recognize this? I need to recognize this if it meets the control and the probable future economic benefit test. Now, from a control perspective, we said, how do you demonstrate control? When I have the ability to use it and generate benefit and derive the economic benefit, or restrict the others from you using it and benefiting from that particular asset, then I am in control. And future economic benefit is nothing but I can generate revenues, I can earn rental income, I can sell it, I can also reduce my cost. You do any of that, you are in command, you are generating economic benefit, and then it meets. And then we talked about the number of different types of intangible asset, which are what types, which could be contract related, which could be marketing related, which could be customer related, which could be artistic related, or which could be technology related. All these are number of different types of intangible asset is what is kind of covered here. And then we also we talked about, if an intangible asset, though it is an intangible asset in nature, but if there's a specific guidance under any other accounting standard, like let's say if you're a reseller of software, then you need to go to Ind AS 2. If it is related to employee benefits, you go to Ind AS 19, and so on. And so if it is exploration assets, of course, then you are anyway carved out. You go to Ind AS 106, right? So on and so forth. If it is a financial asset, you go to Ind AS 32. So you need to again try and understand what is covered as part of the scope of the standard, and that is what you need to consider for appropriate accounting under Ind AS 38 framework. All right. So now we are going to look at this example, and what do we have here? So Congo Limited, a supermarket chain, is planning to start new stores in several locations. In order to promote these new stores, Congo Limited is carrying out regular advertisement through television. Okay. The company has paid INR 16 lakh. So it's a case of an advertisement cost, right? The company has paid INR 16 lakh to an agency, out of which 14 lakh pertains to advertisement till 31st December 2020. Again, important is remember all the dates, remember the amounts. 16 lakh out of which 14 lakh on this advertisement till December 31st, 2020. And the balance, INR 2 lakh, right, pertains to advertisement to be telecasted in the next month. Now, post 31st December 2020, Congo Limited has made additional payment of INR 8 lakh rupees. Now, Congo Limited, based on third-party surveys or research, believes that the stores are going to be successful and hence wants to capitalize these advertisement costs as intangible assets, right? So the question is, what should be the treatment of such advertisement cost for the year ended 31st December 2020, right? So as we've been discussing, right, the advertisement cost are, so this is a rule basically, right? Because it is very difficult to establish that how much benefit you've been able to generate by doing the advertisements and through different mediums. So there is no defined mechanism, and as per the accounting standard, advertisement costs are to be expensed as incurred, right? To be expensed as incurred. Okay. So here I have commitment of 16 lakh, but I've incurred how much? 14 lakhs. 2 lakh belongs to the next period. So that is where the 2 lakh is in a way is like a prepaid, even though I've paid this. And anyway, which whatever thing I'm going to pay subsequent to December 31st, 2020, that is for the advertisement in the next period, which is 8 lakhs. So that anyway will go and hit my next period P&L. So there is no question of capitalization, right? The capitalization principles, the requirement of capitalization are not met in relation to, we're going to look at and apply in this situation under the Ind AS 38 framework. Intangible assets can only be recognized if they are identifiable and have a cost which can be reliably measured. Ind AS 38 specifically prohibits recognizing advertisement expenditure as an intangible asset. The issue of how successful the store is likely to be does not affect this prohibition. Therefore, such cost should be recognized as an expense. It's not allowed to be capitalized. All right. Advertisement expenses are not allowed to be capitalized, and hence recognition of in this case is just not there, and hence you are supposed to expense it. Now you got to again look at the guidance carefully, when to expense, how much to expense. So if my total commitment was 8 lakh, but this much is what I have spent till 31st March and subsequent period, so accounting is a period cost. So in this period, this much cost is going to be recorded. In the subsequent period, I'm going to record the subsequent cost. So amount paid for before 31st March, INR 7 lakh would be recognized as an expense, and 100,000 as a prepayment in the year ended 31st March 2020. Why? Because I haven't still received the benefit. So I haven't still, this money is yet to be spent. I may have paid the advance, but I haven't received the related advertisement services from the service provider, and hence that's not an expense for me. It's a prepaid item. So that 100,000 is a prepaid item, but 7 lakh for which already the advertisement is done and dusted, that's an expense for me. And the 400,000 cost of advertisement paid for subsequent to March would be charged expense in the year ended 31st March 2021. Okay, so remember, advertisement costs are always an expense in all scenarios. In all scenarios, there is no exception to this rule. Now we're going to look at the recognition principles for an intangible asset, and we talked about intangible asset has to be identifiable, and for it has to be identifiable, it has to be separable or emanate from contractual or other legal right, and then you need to be able to demonstrate that I have control and I have the ability to derive probable future economic benefit. And then we talked about how do you demonstrate control is by, in a way, by the ability of getting the economic benefit, or by restricting the usage of that asset, and depriving others from benefiting from that asset, in a way, is how you demonstrate control. And probable future economic benefit can be demonstrated by either by way of generating additional revenue, or by reducing cost, or by way of selling it and kind of monetizing that asset from that perspective. So if you've done all of this, and we also talked about different types of intangible asset which you can have, and we will try and talk more. So when you now come to the recognition as to how much I need to record in my financial statement as an intangible asset, the general principle is it meets the definition of an intangible asset, which we've talked about. It should be recognized in the financial statement if and only if it is probable that the expected future economic benefit that are attributable to the asset will flow to the entity, right? That there are benefits which will flow to the entity, and the cost of the asset can be measured reliably. You can measure the cost, and there is an associated benefit which is related to that cost, right? If you meet both of these criteria, then you meet the recognition criteria. This requirement applies to cost incurred initially to acquire or internally generate an intangible asset. So like it is again both. You may purchase an intangible asset, or you may develop an intangible asset, right? Now you got to look at this from both perspective. The cost incurred subsequently to add to, replace part of, or service. So again, you got to look at it whether it's a maintenance or it is going to enhance the benefit, what you can generate from this intangible asset from a subsequent cost perspective, right? That whether the subsequent cost should continue to be capitalized, or that should be expensed off as incurred. So from a recognition criteria perspective, the cost has to be measurable, reliably measurable, right? And you should be able to generate future economic benefit. And the same principle applies to if you are acquiring this asset from an external transaction perspective, or you are building this asset in your internal organization. And we will also try and understand some differences, right, as to say that if I'm building this internally, right, developing this intangible asset internally, can I capitalize everything, right? And that's where it is important for you to understand the distinction between the research phase and the development phase. And the research costs are always expensed as incurred, whereas only the development costs are allowed to be capitalized. And that distinction is very, very important for you to get it right, as to how much I am allowed to capitalize. And that's where, in a way, it's coming as in terms of the initial measurement. Initial measurement for all intangible asset is at cost, right? Initial recognition is at cost, and there could be in several ways you may acquire an intangible asset. You may do an independent transaction that I want to purchase this painting, for example, or I want to purchase the right related to this particular intangible asset, like a distribution right, for example, right? From that perspective. So if there's a separate acquisition, you pay a purchase price, the duties, taxes. If there are trade discount, reduce that. If the rebates, reduce that, and any other directly attributable cost as we look at the whole in the fixed asset standard as well. So all of that is eligible for capitalization perspective. You may acquire intangible asset in a business combination. If you're acquiring intangible asset in a business combination, then you do accounting for them at fair value. You got to done a fair valuation of those intangible asset and record them at the fair value on the date of acquisition, right? You may acquire an intangible asset under the government grant guidance, right? The government has given you an intangible asset. If the government has given you an intangible asset, you will have to again look at Ind AS 20. And we're going to talk about that in more detail. Ind AS 20 allows you to look at recognition either on a gross basis or on a nominal basis. So you may record at a fair value, or you may record on a nominal basis. And we're going to talk about in more detail when we get to the government grant guidance. But the government has given you an intangible asset, then also it is eligible for recognition. You may acquire intangible asset in an exchange, that you've given something and you've received something, right? So it's a non-monetary exchange of assets. If it's a non-monetary exchange of asset, it is still eligible for recognition, provided there is a commercial substance. Why are you doing this, right? There has to be a commercial substance to that transaction. If there's a commercial substance to the transaction, then you're going to record the fair value of either the asset received or asset given up. So fair value when exchange transaction has no commercial substance, and we're going to talk about this in exchange with the help of an example as well. Or it could be internally generated intangible asset. Now, if it is an internally generated intangible asset, then you are supposed to capitalize this from the date it meets the recognition criteria, and the date it meets the recognition criteria is the date after the research phase is over, and we will again try and understand. So only the development related cost is what is eligible for capitalization for internally generated intangible asset, right? And hence we normally don't see too much of internally generated intangible asset in company's balance sheet. We normally see either intangible assets are acquired in a business combination, or intangible assets are acquired independently in a third party transaction, or in some situation we see that intangible assets are also developed. For example, a lot of companies have developed the websites, right? Those costs is what we see, a website development cost as an intangible asset recorded in some of the company's financial statements. We see some intangible asset in some of the pharma company, but not a whole lot, because in their case a lot of things actually meet only the research phase definition, and they need to expense as incurred. In some of the software companies, we do see some element of cost which are allowed to be capitalized, so on and so forth. So it is a high hurdle when you look at an internally generated intangible asset. It's generally a high hurdle for you to be able to capitalize them. If you purchase them in an external transaction, it is far more easier for you to be able to demonstrate and then capitalize such expenditure, provided it meets all the other requirement. As I said, it has to be identifiable, there has to be a control, and there has to be a probable future economic benefit, and you should be able to measure the amount reliably, right? So let's look at this example. Jupiter Limited acquires a new energy efficient technology that will significantly reduce its energy cost for manufacturing. All right. So it's a new technology which I've acquired, which is going to reduce. So it's like a technology related intangible asset. Okay. Now the cost of the technology is 10 lakh. I got a discount of 1 lakh. I've done training costs for staff in new technology, 50,000. I've done the testing of the new technology of 35,000. I've incurred losses while other parts of the plant shut down during testing and training. So total cost which I've incurred is 10 lakh 10,000. The question is, what all cost out of these are eligible for capitalization? And again, you go to look at the what is it I said, which is the purchase cost and directly attributable cost, the taxes or duties, right? And you go to reduce any discounts or rebates, right? So this is eligible for capitalization. This I need to reduce, so I need to consider this as well. Now training is not eligible for capitalization. A testing is eligible for capitalization. A losses incurred while the plant was shut is again not eligible for capitalization, right? So what is eligible for capitalization is the cost which I paid to purchase this technology is 10 lakh. The discount which I have received 1 lakh, I'm going to reduce it. And the testing cost which I've incurred is 35,000 rupees. So if I'm going to look at the solution, that's what it is trying to suggest, that, you've got to capitalize 10 lakh minus 1 lakh plus 35,000. So total cost which I'm going to capitalize, this is the capitalizable cost. Right? This is what I am able to capitalize, 9,35,000 in this example. So again, it is important for you while you're trying to attempt these questions, right, is to explain why this is also not eligible for capitalization, as these are overheads or costs which are not attributable to bring the asset to its present condition or location, or the costs which are not necessary, for you to derive benefits from this assets, right? So if you have a trained staff, it can start operating the asset from day zero, okay? So, or you can hire a trained staff from that perspective to operate the assets, so on and so forth. So you got to again identify the cost which are eligible for capitalization and the cost which is not eligible for capitalization. What does that mean? It becomes a period cost. Now, a discount rate of 10% and the annuity factor at 10% for 6 years is 4.36. Okay, how much is the discount rate? Is 10%. Now, determine the value of goodwill and other intangible assets to be recognized on acquisition. Ignore the taxation, right? Ignore deferred tax. That is good. Good. So now I need to do accounting for this business combination. Okay. So how much I'm paying here? I'm paying 5 lakhs. How much I've got tangible assets? 3 lakhs. That means 2 lakh is the delta which I need to bridge here. How much I've got a brand? 15,000. Then I've got distribution right, 15,000 into 4.36. And then the balance goes to goodwill. Okay. Let's look at the solution. Awesome. Consideration paid is 5 lakhs. Fair value of net asset acquired is 3 lakh. Brand is 18,000. Distribution right, 15,000 into 4.36 is 65,400. Total comes to 3,83,400. That's the value of goodwill, right? That's the value of goodwill. That's how you do accounting for business combination. Here, I've ignored taxation, right? Ignored the tax. Had there been a deferred tax impact, then on essentially, then you need to know what was the carrying value and what is the impact of deferred tax. And there could have been a deferred tax liability to be recorded, which should have been adjusted then by way of increasing the fair value by the value of goodwill. Okay. Let's look at this example on exchange of asset. Now, this is interesting, right? That when you are doing a non-monetary exchange, right, then we got to be careful about the about at what value I need to record. The first test which you need to cross the hurdle is that every non-monetary exchange is supposed to have a commercial substance, right? Commercial substance. It has to have a commercial substance. Now, assuming that it has a commercial substance, then how do I record this, right? At what value I should record this in a non-monetary exchange of one intangible asset for another intangible asset from that perspective. So Good Group Limited has entered into an exchange transaction with Softec Limited. So there are two legal entities here, Good Group Limited and Softec Limited. Good Group Limited has acquired a software, right, in exchange for a telecom license. The carrying value of telecom license in the books of Good Group is 50 lakhs. So Good Group owns the telecom license, the value of which is carrying value is 50 lakhs. Now the carrying value of software in the books of Softec Limited is INR 1 lakh. So in the books of Softec, the carrying value of the software is 1 lakh rupees, right? Now, there are a few scenarios here. Considering the scenarios below, pass the entries in the books of both the company. Both the company means Good Group Limited and Softec Limited. So scenario 1, fair value of software is INR 52 lakh and that of the telecom license is INR 50 lakh. So I've got the fair value of both. Now, so essentially if the fair value of both is available, then you look at the fair value of asset given up. Okay. Then if the fair value of both is available, then the principle suggests asset given up. Okay. And it is a different answer for a different company, right? For because one company, the asset given up is a telecom license, the other company, the asset given up is software, right? So you got to be careful, and the answer will be different, right? For different company, it's not the same number. Now, scenario 2, when the fair value of the software cannot be determined, but there are observable exchange transactions with similar telecom license. So in which, so fair value one of this is clearly evident, right? Then how do you deal with this? Okay. So essentially, if there is one fair value is available, then you record at that fair value of that asset, from that perspective. simple scenario, right? When you know one at least, but when you know both, then the asset which is given up, that becomes the basis. Now, when you don't know, right, the fair value of both software and telecom license is not readily determinable, then essentially you end up accounting at carrying value. Okay, you do the exchange transaction at the carrying value. That's the principle, okay, which we talked about. So let's look at the solution here. Remember the principle, okay? So we are doing accounting in the books of Good Group Limited as well as in the books of Softtech Limited, right? So first I'm going to do accounting for scenario one in the books of Good Group Limited, and Good Group Limited is doing owning what? Telecom license, and now they are getting what? Software. So software, since I'm receiving software, debit 50 lakhs and to telecom license 50 lakhs, right? Because the fair value of the telecom license which I'm giving up, okay, which I had is 50 lakh, okay. So at fair value of the asset given up, fair value of the asset given up, right? Now, when you look at the scenario two in the books of Good Group Limited, okay, which is there's only one fair value which is available, which is easy, right? Then the fair value of the asset which I've received, which is 49 lakhs, and then I have a fair value of the telecom license, which is 50 lakh carrying value, right? So there will be a loss on exchange, okay. Now I'm going to look at scenario three, right? Scenario three, neither the fair value is available. Okay, if the fair value is not available, then I'm going to record that at the carrying value. Okay, and what was my carrying value of telecom license? 50 lakh, right? In a way, so I'm going to record software at 50 lakh and telecom at 50 lakh. So there is no gain or loss. Okay. Now you got to look at this in the context of the Softtech Limited, right? At what value? So now in their books, the carrying value of the software is 1 lakh, but the fair value of the asset given up, which is software, is 52 lakhs, right? So they're going to record at the telecom license, okay, at 52 lakhs, not 50 lakhs, okay? So that's the important thing you need to remember. Telecom license 52 lakh to software because that is what I've given up. So de-recognize, and then I'm going to record the profit, right? Profit on exchange is 51 lakhs. Okay, awesome. So recognition of new asset at fair value of the asset given up. Okay. Now in scenario two, the Softtech Limited, what will they do, right? Here I have the fair value only one, which is easy situation. So there they will also record the telecom license at 49 lakh. Okay. So telecom license debit 49 lakh, and to software again, that was my carrying value 1 lakh, and I'm going to record the profit on exchange will change to 48 lakhs. Okay. Now looking at scenario three, that's interesting, right? In scenario three, I don't know the fair value of the asset given up or asset received. So what was my carrying value of software? 1 lakh, right? So at what value I'm going to record the telecom license? 1 lakh. Okay, so there will be no gain, no loss. Okay, but look at this, right? The same thing exchange happening, but the carrying value in one company is very different than the carrying value in the another company. Okay, that's the important in a way takeaway. You got to remember the principles. Okay, so if both the assets fair value are available, then the asset which is given up with respect to the party which is giving up, that is how you will do the accounting entry. If only one is clearly evident, then anyway answer is simple, and that becomes the fair value for accounting. If neither is available, then whatever is the carrying value of the asset which is given up, that becomes the new value for recording the asset which you have received in exchange. So that's for non-monetary exchange of intangible. Similar principles are there for tangible assets as well. So let's move forward. Let's move forward to talk about the cost which are not eligible for capitalization. So this is normally we have to deal with when you're talking about an internally generated intangible assets. So cost which are required to be expensed. Internally generated goodwill. Goodwill is never allowed to be capitalized if it is internally generated. Only acquired goodwill is allowed to be capitalized. Internally generated brand, mastheads, publishing titles, all of them are required to be expensed. So a lot of companies build a brand, does tons of advertising. Let's say companies like Airtel, Vodafone, Reliance, Flipkart, Amazon, they keep on doing tons of advertising, as I said, and in the process, they're building the brand. But that advertisement costs are always expensed as incurred, right? So internally generated brands, must-haves, publishing title, all of them are expensed as incurred. Customer list and items similar in substance, if they are internally generated, you're not allowed to capitalize them. Research cost is required to be expensed. The startup cost, establishment, pre-opening, pre-operating, all of them are required to be expensed. Training is expense, advertising is expense, relocating and reorganizing, restructuring, all of them are required to be expensed. And internally generated, again, you got to remember the research phase is always expensed, and the development phase is allowed to be capitalized. And we're going to talk a lot more in the upcoming section. We're going to focus on internally generated intangible asset. Now, for me to quickly recap of what we've talked about so far, for an intangible asset, for you to record that, right, it has to be identifiable, and when it is identifiable is when it is either separable, or you're deriving benefit from a contractual or other legal right. So once it meets the criteria of identifiability, then you look at the recognition criteria, and a recognition criteria is that you should have the ability to control it, and you should have the ability to derive future economic benefit. If you can demonstrate that I can control and I also have the ability to derive future economic benefit, then it meets the recognition criteria for capitalization. And then you need to see that in what form or manner you have acquired this. You can do this in a separate transaction, you can do this as part of a business combination, right? And you can also do an internally generated intangible asset. So there are many. You can also acquire this in a non-monetary exchange. So there are many ways you can actually acquire an intangible asset or build an intangible asset. And then we talked about that there are various types of intangible asset. It could be marketing related, it could be contractual related, it could be legal rights, it could be artistic related, it could be technology related. So there are 5 broad types of intangible asset is what we see. And then you also need to see that whether this intangible asset, it could be also you could also acquire an intangible asset in a transaction with the government. So you then need to see that whether you need to do the recognition under this standard, or you go to get guided by another standard, and based on the scoping criteria is what we have discussed. Now, once you have applied all of this, then you need to determine how much to capitalize. As I also talked to you about, that advertisement costs are never ever allowed to be capitalized in any scenario, and goodwill is only allowed to be capitalized if it is an acquired goodwill. Internally generated goodwills are not allowed, so on and so forth. And then, so that's what broadly is about the intangible asset in terms of the recognition, in terms of what is an intangible asset, right? When it meets the recognition criteria for capitalization, so on and so forth. And we picked up several examples of different types. We've done several examples to do the computations, etc. And very interestingly, we saw the nuance around the non-monetary exchange of intangible asset, that you got to do this with reference to the fair value of the asset given up. If that information is not available, then you will do it with reference to the fair value of the asset received. If that information is not available, then you end up doing it based on your carrying value of your assets given up or received, right? Provided it has a commercial substance, right? So and it can result into a different accounting outcome, for both parties to an exchange from that perspective.